Welcome to Opalesque TV. Today we have Ted Seides, author of the recently published So You Want to Start a Hedge Fund, Lessons for Managers and Allocators. Now Ted, can you give us an introduction into your history in the alternative investment industry?
My first job out of college, I worked for David Swenson at the Yale Endowment. At the time, I think I learned what a stock was and what a hedge fund was on the same day. And it was a fantastic formative learning experience into the world of investing that encompassed traditional and alternative investments. So I stayed at Yale. I thought I might be there for 2 or 3 years. I ended up staying for 5, left to go to Harvard Business School, and then had a series of direct investment positions following business school. About 2 years after I graduated, David had written his seminal work, and all of a sudden this obscure past job I had was pretty well known in the industry, and got introduced to my partner at Protege, Jeffrey Tarrant, through Dan Stern at Reservoir Capital, and that led to a partnership that lasted the last 14 years.
So what was your mandate at Protege when you started with your partner?
We started Protege to have, it was really a fund of funds focused exclusively on investing in smaller hedge funds. And we structured that in a way that was pretty cool mousetrap, pretty unique at the time, where we had one pool of capital that invested in our best smaller manager ideas, and then we also seeded new managers. So we really created a fund of funds focused on smaller hedge funds that also had the optionality of the growth of some of these funds that we seeded. So underlying the focus on investing in smaller hedge funds, and let's start with why smaller hedge funds. The studies have shown that smaller hedge funds outperform largers. I'm always a little bit skeptical of that data. But what we know is that smaller hedge funds, sort of with equal skill, have a better investment opportunity set. And so focusing on smaller funds at that earlier stage of their development was a strategy I saw executed extremely well when I worked at Yale, and then it was something we pursued at Protege sort of throughout the tenure of my time there. So through that strategy, over the years, we invested in 40 different seed managers and probably another 100 or 120 early stage hedge funds. And from that, had a lot of experience, saw a lot of different lessons, mistakes made, successes that led to really me encapsulating them in the idea of writing this book.
So what was your motivation in sitting down and actually writing the book?
One of the things that happened over the years was I found that there were a number of lessons. People would come to me. It's just the normal course of our business being seeders and ask for opinions or advice about how someone could launch a hedge fund. Often it might have been the number 2 or number 3 at a well-known hedge fund. And what I found over time is that I kept repeating the same set of lessons. So depending on what someone wanted to talk about, I might talk to them about how the fundraising process works or how they should build a team, how they should think about their investment strategy, what might happen when they start performing, and then importantly, how do allocators think and behave. And it got to the point in time where I felt like I was saying the same thing to people over and over and over again, and yet no matter who I was in front of, they were kind of wide-eyed and took this as, wow, this is fantastic information. I don't know where else I could go to get this. So I had the idea of putting a number of these lessons down on paper really so that it could reach a broader audience. And part of the backdrop as I started to do this, I realized that unlike the venture capital industry, there aren't any serial entrepreneurs in hedge funds. So if someone starts a new fund and they're successful, they really have no reason to start a fund again. And on the other side, there really aren't that many seeders in number. There's a fair amount of capital, but there aren't that many that have sort of a long experience through cycles to see what happens with a lot of startup funds. So as a result of that, early stage managers tend to make the same mistakes or have the same patterns of success, but there's no knowledge of history. There was nowhere to go for people to understand some of the things they might want to do or some of the things they shouldn't do that other people have done before them. And so I thought by putting this down, it could serve a broader base of people than I was ever able to reach one-on-one.
So give us some of the key lessons that your book can provide for startups and smaller firms.
Probably the single biggest mistake that you see startup hedge fund managers make is not understanding how the business process works. So as an example, these people often are very talented analysts and sometimes portfolio managers, and they study companies. Yet what you find as an allocator is a lot of time they haven't taken that intellectual horsepower and applied it to the industry and the business they're about to engage in. So one of the great examples of that is sort of the marketing process. If you have sat in the seat as an allocator, as I have for a long time, what you find is that there's a certain pattern of adoption that starts when there's a buzz around a new fund, and then allocators are talking about it. And then the fund starts and raises some money, and then they have great performance, and then everyone else wants to crowd in. And there's sort of a way that that happens in the industry that isn't really ever understood by a new startup manager, but is very, very familiar to me and to everyone else who's been in the kind of allocation game for a long time. And so one of the things I try to do in the book is to lay out certain ways that allocators think, and then importantly for managers, how can they give the right signals to investors so that they'll put themselves on the right path for growth from very early days. So one example of that is how managers first approach allocators. So there's a lot of people out there, there's a lot of allocators, presumably there's a lot of money, and what you find is that managers will just reach out. They might talk to their cap intro representative at one of the prime brokers, and they just reach out to a bunch of people. Allocators have filters, and so they can't meet with everyone who wants to meet with them. And how a manager gets either that email in the door or the connection to an allocator will help determine whether or not they make it through the filter. And so rather than just reach out to everyone and this is who I am and I'm so great and you should meet with me, managers should be a little bit more thoughtful, because that initial introduction will carry much, much more weight than they realize when they first reach out to an allocator.
How does a hedge fund best build and develop a successful team?
I think there's two aspects of the initial team build that are helpful to know. The first is that everyone talks about how hedge funds, generally speaking, are poorly managed businesses. Well, it doesn't need to be that way. There's so much to do in the early stages that managers really need to take some time and understand what's their talent development strategy going to be, from who they're hiring to how they're developing those people. And it doesn't take that much time, but it creates great optionality for their business and results. And so that's a simple lesson, but something that is not commonly done in the industry. Now, alongside of that, for those who have the wherewithal to do it, many hedge fund managers are former athletes. And no athlete goes through the athletic part of their career without a coach. And yet, a lot of times people run hedge funds and they don't think about, hey, there could be a coach for whatever I need, or how do I work with my team? How do I build a team? How do I organize my investment process? And there are a few terrific coaches that work with a lot of hedge funds and have great success leading them on the right path. There are a few other lessons in the book that are a little more subtle, but have to do with what happens when these funds get going. So one of them is a simple one that allocators laugh every time you talk about it, which is there are almost no successful hedge funds that have equal co-portfolio managers. There are a lot of reasons why that exists, and it may have something to do with sort of proper delegation of responsibilities. But if you know, looking at the industry, that this two-headed portfolio manager monster is almost extinct, it probably makes sense not to start your business with that model. And yet, you see lots of startups that are friends that got together, people who used to share ideas with each other, that seek out to have two equal portfolio managers. And allocators hate it because it almost never works. There are a lot of reasons that run the gamut, from potentially egos getting in the way to people who aren't fully in sync on their portfolio decision-making process. But sometimes you don't really know until you hit a period of stress. And it might be a period of stress in the markets or a period of stress in the business. And other times you see it work for a number of years until you hit that period of stress. So I can't say I know the exact answer why the co-portfolio manager structure has failed time and time again. What I do know is that if you looked at the history of the industry and you looked at the structure of the industry today, you would come to the conclusion that Darwin has decided that that's a species that should not survive, right? It is not fittest to survive. And so if you know that, it probably behooves a startup to choose a different structure that's sort of more suited for success.
What are your thoughts on investment strategy and some common mistakes that managers make?
So when a manager is really formulating their investment strategy, they need to understand that whatever bed they make, they're going to lie in for a long time. And so that can take on a couple of different forms. And what encompasses all of that is proper communication. So take for an example a flexible strategy. And people think of hedge funds and certainly in the media as moving around their exposures and trading and always making money all the time. We in the industry know that isn't the case. However, if someone wants to have the ability to be opportunistic, to move around their exposures and different strategies, they need to make sure they communicate that to their investors up front so that they can manage the expectations of what that return stream might be like. If they don't do that, you run into situations where a manager sees a new opportunity, they go to shift. If it doesn't work out pretty much immediately, the investors start crying for style drift, and that can cause problems for the business. Well, there are a lot of things that happen when a fund starts, and that's tied to performance. And there's this really a virtuous or a vicious circle that comes out. A new fund starts, if they perform well, they attract interest of investors, they raise money, they have more resources to hire more talented people, and it becomes this sort of self-fulfilling virtuous circle. So what happens is, unfortunately, the early returns end up being a meaningful contributor to the success or failure in the early period of time of the business. Now, there's not a lot managers can do to drive their returns, but there are a few things. So one of them is to put risk on relatively early on. Right? If there's no risk, there's not likely to be return. And if the returns aren't there, they won't be able to attract the interest of investors.
Tell us about the allocator's perspective. What are investors missing in the smaller hedge fund space?
And one of the things I talk about in the book is ways that allocators can improve their performance in investing in smaller funds. And a common one is the pattern of really separating the decision to invest in a manager from the timing of doing so. So we all know that investors chase performance. We all know it, but we still do it. So let's leave that, it's just a fact about investing in all forms of investing. Well, if you're conscious of that, you can realize that when you get really excited about a particular manager, you can make the mental decision that you want to commit and then take your time, maybe wait for a softer patch of performance and then fulfill that commitment and come in later, because those early returns and your results will help. If you have a boss you're reporting to or your clients, ultimately if it helps your returns, it helps the sustainability of your investment process. Doing research and making investment decisions of small managers is really a completely different set of tools and lenses than what most allocators are accustomed to, which we know just based on the structure of the industry, which is investing in larger funds. So there are a few examples of that in the book, and one is the turnover of the team. So allocators are conditioned to think if someone leaves a team, that is per se a bad thing. Well, it turns out in a smaller fund, that's often a natural part of the process to success. So why is that the case? Well, when you start a fund, generally you're resource constrained. So you'll hire the very best talent you can. That doesn't mean it's the very best talent, period. So if you work on this virtuous circle and you have good performance and assets start to come in, now there are more resources. And at times what you see is a portfolio manager deciding that there's somebody else available who he thinks is better than the person on the team. And he'll make those decisions, make those changes, and the team is better for it. However, allocators almost always look at that as a bad thing. And so to highlight that in the book, really for two reasons. One is to tell the managers, hey, if you think you're going to be improving your business for the long term, go ahead and make that decision. Now, it's easier for them to make that decision if the allocators realize that in a small fund, turnover isn't such a bad thing all the time. And you really just need to do your work with an open mind rather than deciding ahead of time, oh, there are problems at that fund I just invested in.
What insights can investors draw from your book about investing in the next generation of outperforming managers?
Well, I think it's a reality of the industry today that the hedge fund portfolios sitting in institutional broader portfolios today will be quite different from the ones that are there in 5 or 10 years. And as some of these managers retire, some of them will transition their business over to a next generation. So think about Farallon so far has done that quite successfully. And then there are others, like a Regiment, Tim Peterson's fund, that when he retired about 2 years ago, 2 years later, the $8 or $10 billion firm didn't exist. The assets left. And so when that happens, we're going to see some turnover. Some of those assets will get recycled to another set of managers. Now, it may be that the $10 billion firm gets recycled into the $3 or $4 billion firm, but some of that money will likely trickle down into the sub-billion-dollar space. And that's going to be an interesting dynamic over the next 5 or 10 years. I think for the first time, we're really going to see meaningful inflows come down market, or market defined by the size of funds.
I'm really curious about where hedge fund managers are coming from right now. Where are these startups coming from? Are they being siphoned off of larger funds? And which ones are succeeding?
What we've seen in the last few years is most of the successful launches, and some of those are billion-dollar launches, so really scale branded launches, are all coming out of existing hedge funds. So in the past, maybe you go back 5 years, 10 years, post-financial crisis, there was this notion that there'd be a wave of prop traders that turned into hedge fund managers. And there were some, but really not that many. Over the last 10 years, as we've seen the institutionalization of the hedge fund industry, by and large, all of the talent that's creating the next generation is coming from the number twos and number threes in existing hedge funds. However, every year we do see a few smaller funds that have generated outstanding performance sort of for the right reasons and haven't come from that environment. And they kind of come out of the ashes and really can build formative businesses. But for those people, it takes proof of concept. The allocators need to see the investment returns. They need to understand the process, and then they need to watch it for a while. So those returns really need to sustain themselves for a few years before allocators are likely to adopt kind of a less discovered fund.
In general, where is the hedge fund industry right now, and how do you see it adapting going forward?
The hedge fund industry has definitely hit this inflection point where I think aggregate assets are slowing, and that comes because the broader pools of asset allocation from all the pension funds and sovereign wealth funds, endowments and foundations and families of the world have adopted hedge funds, have allocations, and those allocations might still be increasing a little bit, particularly in some of the larger, later moving pools. But for the most part, it's pretty stable. So what you're going to start to see is increasing competition just within the hedge fund space. So we'll see if these large funds can continue to retain those assets and grow as they transition from their founders. And we're also going to see really significant competition within the industry to really capture market share.